Welcome, everyone. One of my favorite days from an econ geek standpoint. It's Fed Rates Day, Fed Decision Day. In one of the most widely telegraphed moves we've seen in a while, the Fed cut rates 25 basis points today, so another 0.25%, after a cut, of course, back in September of 0.25%. We think most likely there's another cut coming in December. And then our likely scenario is a pause after that. But the reality is the uncertainty bands get pretty wide once we pass through December. Powell, of course, signaled today that there is some uncertainty about the December rate cut. And one of his key points was just that there was strongly differing opinions, to quote him, between the different members of the Fed. And we even had one dissent today who did not want to cut, as well, of course, as anticipated, Stephen Myron wanting actually a 50 basis point cut, or an additional 50. So we've seen a pretty wide spread there, probably more dissent and more disagreement in the Fed than we would have thought. But other than that, it was pretty much as expected. I don't know what your takeaways were, Scott. So we've got Scott McGrath, by the way, here. He runs rates desk for us, and Thomas Montgomery, who recently joined Huntington. His previous employer was the Fed in Washington, D.C.
Yeah, thanks, Ian. I think my main takeaway was, as you stated, the expectation was for the 25 basis point cut, but I think the market was wanting a certainty for another cut at the December meeting. And, I think Powell's exact words are they were far from a foregone conclusion of cutting in December. And I think that spooked a little bit of the market, at least as you looked at the market reaction, right? A lot of our customers think, oh, if the Fed's cutting rates, that's going to transfer to, long-term fixed rates, either that's commercial borrowing rates or mortgage rates. But you actually saw those move higher after his comments, as the market was pricing in a lower probability of a Fed cut in December. Going into the meeting, it was nearly 100% priced in that they were going to cut. Now it might be 60%, still likely, right? But less of a certainty. And I thought that surprised the market a little bit, and you saw that in the reaction both in long-term fixed rate yields moving higher, and you saw stocks correct a little bit lower as a result.
What were your thoughts, Thomas?
Yeah, I'm happy to be here. And this meeting was an interesting one. A lot of people were expecting that we would get that the focus of this meeting would be on QT and its end, which we saw signs of about 2 weeks ago in the speech, and then increasing pressure in the bank funding market over this past week. And while that did happen, QT is going to end December 1st this year. The focus was largely on labor markets and the increasing signs of fragility and heightened risk. Despite that heightened risk, to your point, no commitments to cuts in December. That's far from certain in their eyes.
Yeah, certainly. I think we saw Powell advocating for the importance of federal economic data, as well as saying, look, we're prepared to operate without it. And we have a wide range of alternatives, whether ADP, for example, on the employment side provides a pretty good employment alternative. Inflation data is a bit weaker, as he somewhat highlighted. And, we really don't have an alternative to GDP data. So we saw that discussed a bit. I think one of our takeaways, from the dot plot last month, which says where Fed governors think rates are going to go in 2026, is there's a pretty wide dispersion. And I don't think this did anything today to change that in terms of where a rate's going to go. But if you're talking about short-term borrowing costs, and really the thing with Fed funds rate, of course, is to remember is SOFR essentially, so what companies borrow at the rate typically companies used to borrow. And Fed funds are pretty much one and the same. You should think of them as the same rate until you go out in duration a bit. And then, of course, Fed funds is an overnight rate. And SOFR, there are swap alternatives that go out much further in duration. But what we expect for next year, what the dispersion tells us is there's no path to hikes. It's a very asymmetrical distribution, whether it's a fairly large magnitude of cuts that could get you down to 2.5%. I think a more likely scenario is probably around 3% flat next year, but likely you could have a pause. And depending on the data, as the data come in, what could happen is we really could see a repeat of 2024 and 2025. And what happened was, anticipated cuts we had at the beginning of the year didn't happen. And they waited and waited. In 2024, they waited for the first cut until August. In 2025, they waited for the first cut until September. Do we see that pattern repeat 3 years in a row? It'll be interesting to see.
Yeah, I think you nailed it, Ian. And I think what we get from this meeting is a continued data-dependent Fed, which means continued volatility. You're hanging on each data point, each headline, each trade or tariff negotiation, and that just leads to a less certain, forecast. And you can see, rates bouncing up and down accordingly. Rate cuts get pushed out or get accelerated, et cetera, and that all will continue to be volatile based on how things come in.
We have a couple things happening in the labor market. We really have a big slowdown in the supply of the labor market. He talked extensively about that. So what is the pace of job growth we need right now to keep unemployment stable? It may be very low. A recent Dallas Fed researcher suggests it might be as low as 30,000 jobs a month is all we need to add just to break even in terms of unemployment because of that large slowdown on immigration. And as Powell pointed out, the Fed's tools are designed around the demand side of the labor market. How do we accelerate or slow down demand for labor? They have pretty much no tools to control the supply side of the labor market. And that's really where we're seeing a lot of action. And he really emphasized it, that he thought the slowdown in job growth, as he put it, to quote him, was mostly a supply function. What were your thoughts, Thomas? What are you thinking about with this decision today?
Well, I want to touch on something Scott said just a moment ago, which is about the tariff side of the inflation equation. And as Powell was asked about this, they're still sticking to their baseline assumption that tariffs will be a one-time price increase, albeit something that will percolate and trickle to the consumer over time. I think they mentioned something like this spring, maybe as late as April, because a lot of these tariffs went into real effect sometime in August, which as it percolates down the supply chain, as suppliers aren't able to shield consumers from costs, that will show up on people's grocery bills and other expenses. But the reality is, as part of the inflation bucket, goods aren't that large. On that front, we've seen housing costs, or the rate of inflation for housing, continue to come down, but the services, except for housing part, is still hasn't quite picked what direction it's going to go yet. And that's where there's still some uncertainty. I think that hawkish dissent today, as well as what we're told, strongly differing views about what to do in December, are more around the services side of inflation.
So, yeah, I think the key takeaways, if I'm a client thinking about it, a couple things. One, rates likely another cut for the overnight rates coming December, but maybe not quite as likely as we thought. I think Scott and I both thought it was pretty much 100%. After the comments today, maybe it's a little less, but at the same time, I think Powell sometimes wants to leave a little uncertainty there and a little hedge. And maybe it really is a lot closer to 100%. He just doesn't want to feel locked in. If the data do come in and they have a data-dependent Fed, they may do something different. But I think, another 25 then there's a lot of uncertainty in the next year. But a lot of cuts are already baked in if you're going out in the swaps market. So if a client really wants to lock in fixed rates, those future cuts exist and are basically, you can buy them at this point. You can lock yourself in if you want. That is available to you as an option. But right now, they want to maintain a certain degree of strategic ambiguity going forward. And that was kind of my key takeaway. What did you guys have? One last takeaway for our clients.
Yeah, I think you gear up for some volatility. Pay attention to the Fed speakers intermeeting here as we get to the next meeting on December 10th. See what they're thinking. As noted, there's a wide dispersion in thought. And just kind of hang on for the ride. If to your point, Ian, if you're sensitive to the short-term fluctuations, there are ways to mitigate that risk and take advantage of maybe what could be an over-optimistic market in terms of expected cuts in the future. So
I would have to agree with you, Ian, a little bit there, that Powell and the Fed in general like to keep the door open for what decisions they can make in the future. And when you hear this term data dependence from the Fed, what that really means is that they want to reserve the right to make their decisions based on the latest data and the most precise, most correct, most revised data that they can, and not tie themselves or make the market expect something when there's a possibility, however remote exists, that the day could come back and they decide they would be suited better to go down a different path.
Thank you, everyone, for joining us. Appreciate it. And as always, like, subscribe, follow, check out our Huntington commercial channels, and whether it's on LinkedIn, YouTube, or wherever else you're watching us.